With unmistakable candor and charm, may I add, permit me to share a morsel of wisdom tailored for homebuyers navigating today's rather, shall we say, unique real estate and mortgage market. Brace yourself for an innovative strategy that you may think you already know, but do you really? Yes, I'm talking about the Buydown, specifically the 2-1 Buydown. This is a pivotal episode of the Martini Mortgage Podcast, episode 183, titled ARM vs. Buydown. To start, the term ARM stands for adjustable rate mortgage. Though it might appear glamorous with its appealing headline rate, in reality, it may turn out to be pricier than deploying a buy-down strategy. However, before we dive deep, I need to make those legal folks happy. I am Kevin Martini, and I am a certified mortgage advisor and producing branch manager, NMLS 143962, with the Martini Mortgage Group at Gold Star Mortgage Financial Group Corporation, NMLS 3446, Equal Housing Lender. The primary purpose of this podcast series is to inform, entertain, and educate. The information, opinions, and recommendations presented in this podcast series does not constitute legal or other professional advice, opinions, or endorsements of any kind. Let me begin by addressing the current issue at hand. The notable elevated mortgage rates, a marked shift from the recent past. These developments may naturally push some towards the allure of an adjustable rate mortgage. However, it's essential not to ignore the less apparent appeal of a buydown, a virtual hidden gem for potential homebuyers. In the realm of buydowns, homebuyers transform into borrowers may unearth anticipated benefits from a buydown that they wouldn't from an ARM. Moreover, with an ARM, it's not a matter of if, but when you must refinance. But with a buydown, your choice to refinance hinges on when the time is right. And with a correctly designed mortgage strategy, it could translate into extra cash by utilizing your quasi-asset that is created with the buydown. Here's the catch. Your mortgage must be meticulously planned at origination, which is rarely the case with an ARM. Moreover, it must be flawlessly managed post-closing, a free service I provide as a certified mortgage advisor. It's crucial to remember that mortgage rates are cyclical and won't remain static forever. According to the Mortgage Bankers Association's June 20th, 2023 forecast, the projected 30-year fixed rate will begin with a 4 in 2024. The critical point here is this. With a buydown, the blended rate until refinance is less than with an ARM. For those that are multitasking, let me reiterate. The blended rate is lower with a buydown strategy than with an ARM. Moreover, a buydown is a sophisticated strategy to save you money now and later and has the ability to provide you with a quasi-asset. Let me shift gears and decode this elusive 2-1 buydown. Picture this. The seller, at the time of closing, pays a fee that will dramatically reduce your mortgage interest rate by 2% in the first year and 1% in the second year. The result? A substantially lighter mortgage payment, making homeownership financially more accessible. The 2-1 Buydown reduces your interest rate and monthly payments during the initial years of home ownership, substantially enhancing home affordability. It helps you attain your dream home earlier, fostering equity growth rather than extending your residency as a tenant. In my experience, more sellers are willing to consider a buy down than a price reduction. The 2-1 buy down, when properly structured, can have more substantial impact on reducing your monthly payment than simply a price cut. Given the current market state, characterized by frequent price reductions and higher mortgage rates, this strategy could be a powerful negotiation tactic. I have confirmation of this fact with the families that I serve. However, what happens when home loan interest rates return to normal levels is your question. In the third year of a 2-1 buy down journey, your interest rate reverts to the standard note rate. If the market interest rate remains steady or on the rise, you typically continue with the loan and regular payment. Yet, if the forecasted recession hits, leading to a decrease in mortgage rates, you would have the chance to refinance at the contemporary rates. Remember, interest rates are cyclical. They rise in a booming economy and fall during a recession. Before we wrap up, let me touch base on potential tax benefits. Remarkably, the buyer can claim seller-paid buydowns as a tax deductibility if they itemize their taxes, even though the seller pays for the buydown. Similarly, sellers can deduct the buydown payment made on behalf of the buyer against the capital gains upon selling the property. It's considered a cost of sale. Now listen, I'm a certified mortgage advisor, not a tax accountant. More details on these benefits are available in IRS Publication 936. To sum it up, the buy-down strategy overall proves to be more potent than an ARM. Purchasing a home is a significant commitment. While an ARM might be the best choice, based on my experience, it's not the ideal strategy 9 out of 10 times. The only way to truly know is to have a confidential conversation with a certified mortgage advisor adopting a fiduciary approach. That is exactly what I am, and this is exactly what I do. My name is Kevin Martini, and I'm a certified mortgage advisor with the Martini Mortgage Group, and you can reach me by dialing 919-238-4934. Thank you for tuning in to the Martini Mortgage Podcast. If you found this episode insightful, please share it with someone you care about.